Everybody. Thank you for joining in today. Previously, in the last session,
Hi, good morning.
we had in the last session with us Mr. Nitesh Tripathi, and he discussed about product management. And today we have Tushar Kansal, the founder of Consultancy Ventures, and he has a rich experience of more than 20 years into financing, venture capital, startup, and funding. And the session is over to him, and we're going to talk about financing of a startup. Over to you, sir.
Thank you, Apurva. Thank you so much to you and InWebinars team. And I was looking forward to doing this seminar today, this webinar today. And I'll be happy to assist all the startups who are watching and who would watch later on as well. So I'll just start with a presentation which will give the salient features of what all we have to discuss today. By one. The first one is, which Apurva had told me to cover, was how is the old way of raising early money different from today's ways of raising money? It's a very interesting question. So earlier, India used to have 25 to 30% of global GDP, which would mean we were already a huge economy, and funding or financing was easily available, because without funding and financing, one can never have that kind of a GDP. So it was all community based. So if you know Sindhis, Gujaratis, Telugus, they would help each other get access to markets, get access to funding, and also a business network, which used to rely on each other through a community based approach. In the West, it was from the time when the British and French and these guys were making colonies, they used to pool money. Before that, for an example, people used to own a ship, and the problem was the ship would not come back in many cases. So they used to lose a lot of money. So they started crowdfunding. So they would pool in money, and through that money, they used to own a number of ships. So it was a portfolio approach, wherein even if some ships didn't return, they had a substantial presence across the shipping industry. The ease of raising equity money has come from the concept of a corporate whale, which means that if there is a company which is incorporated and it has shareholders, then the liability of the shareholders of the company is limited. If the company makes losses and has to pay back its stakeholders, then there won't be a personal liability on the part of the owners of the company. So that's what corporate whale. So corporate whale has strengthened entrepreneurs. They have a cover now of a separate legal identity through which they can borrow money as a debt, or dilute the shareholding and raise equity, and not be bothered about the risk, because the risk does not cover them personally. Then the concept of equity and shares came in. Earlier, it used to be mostly partnerships, but later on, there was a fractional division of shares, which assisted in fundraising on the equity side in a big way. Last but not the least, we have seen what stock markets have done to the idea of raising money externally. So, just to give you a sense of what stock markets have done to the current fundraising scenario, 1.5 years back, Amazon used to be a $1 trillion market cap company listed on the US stock exchange. And we used to wonder that, how can a company be $1 trillion company? Because there are not even countries who are $1 trillion. But within a matter of 1.5 years, the pandemic came in, and the value of Amazon became $2 trillion. So a company can grow from 1 trillion to $2 trillion in a matter of 1.5 years. This is what is called the magic of stock market, because the people were sitting at home because of the pandemic. They had nothing else to do, but they wanted to earn money to get them going. So they had access to very cheap stockbroking softwares, like in India, Zerodha, or abroad, you have many. So they just latched on to investing in the stock market. And because these shares are being traded across investors, so because they were sitting at home, the tendency was to buy more, because they wanted to be involved in the stock market. And because these buyings were happening, a company like Amazon became $2 trillion from $1 trillion. And when we talk about some companies in the US by the acronym FANGS, FAANGS. So these are the top tech companies whose valuation has crossed or reached almost $1 trillion. So Facebook, Amazon, Netflix, Google. So these are the companies which are a part of that. So we have witnessed the same scenario in India as well. And if one sees the Reliance, which is the company having 10% of all market cap of listed companies in India, its valuation has also jumped along the way. So next question, what is bridge financing? So suppose I am a company which wants to raise a Series A round of $2 million. And that round I'm supposed to raise only when my revenue reaches, say, around $300,000. Then I would typically think that I have 6 months to raise this money based on the calculation of my cash burn as on the moment and the money I have at the moment. Then there is a scenario that I will fall short of cash and I would need to raise some money in between. So that money which is raised in between two rounds is called bridge financing. It is of three parts, three ways. One is the equity bridge, which is what I do is I tell the fund or the investor that before I raise a Series A round, I would place some of my shares as collateral with the investor and want to raise a money in between, which is called a bridge financing. Similarly, we have a loan bridge, which is typically we go to the bank and say that although my debt requirement is much more, but I have visibility of cash flows in the future at certain point in time. So till that time, the bank should lend me some money. And what happens is that in these cases, because the bank knows that your requirement is quite important because of your cash burn, so they lend you money for less than 1 year tenor at high interest rates. So this is called a loan bridge. Then we have the IPO bridge. So I am a company which wants to launch an IPO, list myself on the stock exchange. But the market conditions are not good. The market is choppy or volatile, or there are some macro conditions because of which I'm not getting a good valuation for my shares on the stock market. So I go to IB, which is the investment banker, and tell him that before he floats my shares on the stock exchange, he can provide me an IPO bridge. So the IB will take some of your shares, keep them as collateral with the investment companies like banks and financial institutions, and provide you some bridge money, which is called the IPO bridge. Then very important, very important is convertible. What happens is today, Apurva comes to me and says that the value of her company is 100 crores. And I, as an investor, feel that it should not be more than 20 crores. So this kind of a gap in expectation on valuation is difficult to bridge. So what we do is, instead of putting in money and taking plain vanilla equity, we take a convertible. A convertible can be preference share, can be debentures. Alternatively, it can be warrants. So what happens is, suppose we take convertible preference shares. then those preference shares are a type of instrument which have a higher rating as compared to normal shares, and they appear on the balance sheet. But these shares being convertible will get converted to plain vanilla equity shares at some point of time in the future, basis a formula which me and the founder of the company, they decide and put it in the shareholders agreement. So I can say that I'm taking a convertible, but my convertible will get converted into equity based on the performance of the company in terms of revenue and EBITDA 1 year down the line. And at that time, whatever would be the performance of the company, there would be a multiple to that, and we can arrive at the valuation. So we can say after 1 year, 5 times revenue or 10 times EBITDA, whichever figure is lower, that would be the valuation of the company. And whatever money I'm putting in today will be converted into equity at that formula. But one must note that because I'm putting money today, so I should get a benefit. So usually what happens is there is a discount to the prevailing valuation in the future, which is given to me. So I can say that my convertible will get converted when the next liquidity event happens in the company, which means that whenever the next funding round will happen, my equity will also get converted, but at a certain discount, say around a 20% discount. So I was doing this company, fintech company, their first round valuation was 40 crores. Now, they wanted more money, so they issued a convertible which said that if in the future 1 year, the next funding round happens, then my equity will get converted into equity. My convertible will get converted into equity. If the valuation is more than 60 crores in the next funding round, then I will be given a 20% discount on that valuation. If the valuation is less than 60 crores in that round, then my conversion will happen at the previous round's valuation, which was 40 crores. So that is the advantage a guy taking convertible gets, because he's investing today and bearing more risk by investing at this stage in the company. Similarly, there are differential voting rights. So Mark Zuckerberg owns less than 50% of Facebook, but his control over the board of directors is more than 50%. He's actually he controls the whole board. And that is possible because his shares, which are with Mark Zuckerberg, they have higher voting rights as compared to the shares held by the other investors who came in late in the company. So we have DVRs in India also, and the Tata Group is famous for using DVRs to maintain controlling rights over the companies which they own, but in which their equity shareholding is less than 50%. I'll move on to the next. Why do investors go after a small idea with a bigger growth strategy rather than a big idea with a smaller growth strategy? So the world is such that a lot of money is sloshing around the system and is controlled by very few people. So if you look at Russia or Pakistan, or okay, not Pakistan, you take up some good economy. The top, it's like a pyramid. The top people sitting on the top have access to vast amounts of power and money. So they use, they want to build a legacy for themselves. So sometimes they build vanity projects. I mean vanity projects, I mean that which satisfies their ego. So Abdul Gamal Nasser was the president of Egypt. He built the dam on the Nile, and he said that the problem of less water and flooding at the same time will get finished once this dam is built on the Nile. And they put in everything on the dam, and what happened was the sensitive and fragile ecosystem of the Nile in the Egypt Delta region, it became destroyed permanently. So there was silting, there was desalination, which means that the salt mixed ocean water used to come in back into the fresh water. So it destroyed the whole ecosystem. Similarly, we have seen China has built the Three Gorges Dam, which is a huge dam, which and they had a problem of flooding for hundreds of years, but that dam has proved to be very sensitive for the ecosystem. So big ideas sound very nice, world's tallest building and so on, but they are not typically the one which would result in the same kind of return which a small idea can do with a bigger growth strategy. I'll give you an example like Khan Academy. So Mr. Khan used to teach his cousins, and the cousins said he was a bad teacher. So they told him to make videos, a small 10-minute videos, which the cousins could use to understand the topics. So once he started making videos, he realized that these videos can be used by anybody. So he started putting them on the website. And it became so popular that Bill Gates called him and gave him $100 million to make it a full-fledged venture. So for the example of Twitter, if you go to Twitter and open an account, immediately you will feel that, okay, no, this is I don't know what it is. Till the time you see a feed coming on your Twitter. So when Twitter onboards you, it starts asking you to choose from the handles which you can follow. Once you choose the handles, you start seeing the tweets. Then you start becoming interested. So it's a small idea, but the growth strategy was pretty strong on the onboarding side. Similarly, LinkedIn. Somebody registered on LinkedIn. LinkedIn used to ask for the Gmail password and immediately used to connect with a lot of other people. And when you saw that, oh my God, these are all people who I know since a long time, and now I can stay in touch with them. And so that onboarding and growth experience which LinkedIn provided, it was a very small idea, but it turned out to be big. Similarly, if anybody of you have used Airbnb, the best part of Airbnb is the user reviews. So they are very simple 5-line reviews, proper rating, and across each parameter, they have given the rating. So this is what it works. And I'll just give you more examples. So, in the Soviet Union, everybody knows it was a single government country. They used to do things like draining the entire Baikal Lake. They said this water can be used somewhere else. They shifted the entire population of Kazakhstan to somewhere in Eastern Europe, the entire population. So, these are all big vanity things which does not necessarily result in a good outcome. Last example is of WeWork. Everybody knows WeWork. Now, WeWork was born with an idea that office culture is very formal and people get very constricted while using formal offices with dressing sense and everything. So Adam Newman said that the future of offices will be community based. They will be eating together, playing sports together, and different people from different walks of life will come and interact with each other. And hence, once he got money from SoftBank, he took the best properties in the best locations at 3+3+3 9-year lease and made them into 7-star properties. And it was a beautiful idea, but it was a big idea. And the growth strategy was very poor, that people who are from the gig economy and people who don't have a stable job were the typical customers of WeWork. So look at the model. On the one hand, you are paying through your nose for top-end properties built in 7-star fashion. And who are your customers? Your customers are people who can't pay even for average properties, whose jobs are not stable, whose businesses are not big, and who are mostly single person business. So this is a very good example of the failure of big idea in WeWork. So growth strategies, there can be 4 ways: market penetration, product development, market expansion, and diversification. So that's a whole different topic to speak on.
One quick question here, Tushar. When we
Yeah.
talk about growth strategies, and while we were discussing about the ideas or the examples that you gave, a quick thought that came to my mind was regarding marketing or promoting. So, do you think how important is a right set of marketing should be there in any idea when we talk about growing? For example, recently White Hat Junior has gone a lot of bad name because of the adverse marketing that company has done.
Which company?
White Hat Junior, the one who
White Hat
was
Junior.
supporting,
Okay,
yeah.
okay, right. So the first imperative is that the solution which you propose for a market problem should be there. I mean, it should have a value. Only if you have something of value, you can market it and get success. But if the idea itself is based on vanity, ego, pride, or it is an idea which is not practical, then the best marketing can also not do something about it.
Correct.
The example which you gave was which one? Sorry.
White Hat Junior.
White Hat Junior. Okay. Now, what is happening is dot-com boom happened in dot-com bust happened in 99, 2000.
Correct.
Then 2008, the Lehman crisis happened. The global economy was shaken. And in 2020, COVID pandemic has happened. If you look at the outcomes of all these disruptions in the global economy, then you would realize that there is a one thing which is marching on in our lives, and that is technology. With each disruption, the march of technology goes ahead. So people want stuff at their homes. They want it faster. They want it from in the proper price. They want to be able to buy things through an app. They want to be sure of the ratings of the company they are buying from. On the product side. On the services side, they want everything in the least amount of time and in a good pricing. So you talk about White Hat.
Yeah.
Now what happens was anybody who's in technology and who's not in technology, there is a vast difference to the kind of business both can do. And scalability and comes from technology. And because the smartphone is the new home of the people, so that's where the role of technology also comes in. White Hat identified a very critical gap that coding was a field which people saw that there are a lot of money and rich people are coming from coding background. So he identified the need for providing coding to the masses. Now the best part about that was he just focused on coding. He just left everything else. So there was a strong product differentiation. Secondly, it was being provided over the internet. The third thing which benefited was that the COVID pandemic came and suddenly their revenue became 12 times. So when you have a gorilla sitting in the room like Byju's, who's so big, it gobbled it up in $300 million. So that's a lot of luck also there and a lot of smart marketing, because the need for parents to ensure that their kids are up there in the technology side, was very smartly identified and used very nice marketing strategies, some of which I don't agree. So when I see those advertisements on Facebook saying that Mark Zuckerberg became from a coder to $1 trillion guy. So I mean, essentially, you are not telling the pain behind that guy's effort, how he left his education to pursue his dream. He left the formal college. He took that risk because it was just a platform. There was MySpace before that, and there were others who were not succeeding. So this guy took a chance. And so you're not actually telling about the whole balance of how it played out. So, and also, they say your child can become CEO for a day. Now, I find it quite amusing because I remember when my daughter was so small, Mother's Pride had come to me saying that they wanted her to participate in a beauty pageant. So I was like 2.5-year-old kid participating in a beauty pageant can only mean ego and vanity pride for the parents because the kid will never enjoy it. So this is the balanced view I have about White Hat.
Got it. Yeah.
Okay, I'll move to the next question.
Yeah.
Yeah. What are the best practices to connect with investors? Now, a lot of people, they get very jazzed and they get very hooked that, oh my God, I have to approach venture capital funds. I have to approach investors. They will put me under pressure. How will I see, how will I deal with them? And the worst part is the fund guy will say no to me. So if I get 2-3 no's, then I start getting jittery about my own business. That whether this has the right ingredient in it for it to succeed. Now, more than success, a lot of people start benchmarking their success not on the fact that the business will make money, but from the fact that the investor will put in money. So those large dollars which one sees in news articles, they start becoming more important than the business itself. So the founders start seeing themselves as investor in their own business rather than the founder. So my advice to them is very simple. The fund guys haven't come from the moon. They are from the earth. It is just that they get 20 to 40 decks a day. So they basis their investment thesis. They keep talking to the companies in that space. So they have more visibility of what is happening in the sector. So you have to create your presence by ensuring some things so that they are very amenable to listen to you. And once they listen to you, you can, 50% of your job is done. Have a good internet presence. Have a good LinkedIn. Have a good, good amount of articles. There are a lot of websites available. If somebody searches your name or the company's name, the first 10 or first 20, only first 10 or 20 is matters. Beyond that, it doesn't matter. On Google, first 10 or 20 links should be good about you and about your company. So in case you need to take help initially, you can take help of incubators. So GSF is an accelerator in Gurgaon. I've heard very good things about Mr. Sani. Then there are the fancy ones like India Accelerator in MG Road. Then there is a PadUp, which is more of owned by 4X CXOs. They handhold you for 2 years right from the idea stage. So these are some of the ones. So I can probably suggest more. So you can take their help. Now, how to reach out to investors? You should try to go through some founders of the company where the investor has put in money. That will give you the good credibility that you are approaching through the right channel. So you are, your credentials get built. In case you are not able to reach investors through someone, then you send them a personalized invite on LinkedIn, and that invite should be 5 lines long and briefly give something about you with a request to connect. And I've seen most of the investors, they look at this kind of a thing not badly. I mean, they would, most of the cases they will accept. And then your pitch deck and the financial model should be very clear in front of you. And VCs are, unfortunately, they are constricted by time. So unke bhaav hote hain, they have a little bit, they will like to keep their upper hand. So you have to just, bear with it. And you should be able to tell your business story to the investor in 10 minutes. If you do that in the first 10 minutes, believe you me, you will get attraction. The pitch deck which you have, it should not be like 25 slides or 20 slides, 10, 12, 13, because, as per a study, a pitch deck, an investor spends around 90 seconds on a pitch deck. So you can rather show him a 2 to 3 minute YouTube video, or you can send him a 10 to 12 slide pitch deck, which can be read in a short time. Then one very important thing is do your homework, which means that every VC has their investment thesis and the portfolio companies on their website. Now, you might find it lazy to actually go through them, but believe me, if you know their investment thesis and the portfolio companies, then you will be approaching the right investor, and your chances of success will only go up. So this is what, and the last thing is, it's a very famous thing about life that everybody is different. Everybody thinks differently. They have a different alignment. Now, when I make relationships with investors, some investor would like to sit with me on a beer and talk about markets or talk about investments or talk about how to get good valuation from the startup founders whose expectations on valuation are so high. Somebody might want to sit with me over a coffee and talk about general personal life and not so much business. Somebody might say that, okay, Tushar, I would like to associate with Tushar because he brings quality deals. So my time, is properly utilized, because if Tushar says some deal is coming, then he would like to spend more time on that. So you have to align yourself with how people are, and that's true about VCs, and that's true about the other things in life as well. So this is about this question. Should I move on to the next, Apurva?
Yeah, I think a lot of good download would have been given by you on networking, because the very
Yeah.
basic question, the important one, is like how to network and how to reach these people. And I think you have fabulously elaborated on how to really talk to a VC and how to make someone very worthy of your idea.
Yeah.
Thank you so much.
Yeah. So that's good. I mean, so I will just add one more thing to it. Like one goes to events and then one exchanges visiting cards.
Correct.
Now, immediately after saying hello, exchanging card and giving a 5-liner to the investor that I'll be sending you a mail on this. Immediately send them a mail, follow up, and nothing is rocket science. I mean, a lot of investors get put off by the fact that the investor didn't consider them seriously.
Correct.
So what? I mean, there are other investors. Everybody is an angel investor nowadays. Even a builder, a property dealer, regular business guy, a techie guy, a CXO, everybody is an angel investor. So just don't give up.
Correct.
Now, how to read a startup term sheet? The first part of the term sheet is whether it is binding or non-binding. If it is a binding term sheet, it means that after the due diligence of the company, the investor has to put in money in your company. But of course, whatever facts have come out after due diligence, there will be a repercussion of that on the final investment. So if somebody said, I'll put in 10 crores in your company and the term sheet was a binding one, it might be possible that instead of 10, he puts 8 crores or 7 crores because there were certain adverse things he found from the due diligence. But he will put in money because it was a binding term sheet. A non-binding term sheet means that he has a right to back off from the investment at any given point in time, even on the last day. Then company valuations, at what valuation the investor is putting in money, what percentage stake he's taking. If it's a convertible, then at what formula will the convertible get converted into equity? Anti-dilution means that suppose I'm the first investor in your company, I put in 1 crore, I take 10% equity, so the company is valued at 10 crores. Now in the next round, instead of you getting valuation more than 10 crores, because of certain reasons, you brought your valuation down to 7 crores. So my initial 1 crore, 10% equity, the value of that becomes from 1 crore to 70 lakhs. So because the valuation, the next round valuation was less than the previous round valuation, the company will issue me 30 lakh worth of additional shares to compensate me for the 30 lakh loss on the valuation which I have incurred. That is an anti-dilution clause. ESOPs is employee stock option pools. So a lot of these startups, they are unable to pay market-linked salaries. So they have certain salary structure, and other is ESOPs. ESOPs are rights to have equity shares in the company, and they have vesting periods. So some ESOP will vest in 1 year, 2 years, 3 years. So it will ensure that you stay on with the company, and they are also linked to the valuation. So they might be issued at a premium, or at a discount. Then the instrument, I told you, it can be preference shares, debentures, plain vanilla equity, or warrants. Now these preference shares and debentures, they are quasi-equity, quasi-debt. So which means that till the time they are converted into equity, they can be treated as debt. So the investor has a right to get some interest rate, or in this parlance, it is called coupon. So if I have taken a preference share, I might get a 7% coupon, which means till the time it is converted into equity, I will be getting 7% interest rate on that amount. But 7% is too high. I mean, in many of the cases, the coupon is actually very small, like 1% or something. But in some cases, when the investor says, I'm coming in early with a lot of risk, then they expect a proper coupon. So they would expect, one deal I did, there was 8.5% coupon. Another term sheet I saw from InfoEdge, it was a $5 million term sheet with 14% coupon. Now, that is mind-boggling. I mean, 14% coupon means that some startup who's willing to pay 14% interest rate. So, how will that startup go forward, if it's paying so much of interest rate? So these are instruments. Now, there are conditions precedent and conditions subsequent. So conditions precedent can be that whatever disclosure the startup has made to the investor in terms of financials, in terms of business, in terms of contracts, they are true. And the company certifies to the investor that they are true. Conditions subsequent can be that the investor will ensure that the company will ensure that the shares will be transferred properly and so on. Then there are voting rights. I told you that each share has voting rights on the board of directors. There are reserved matters, like the investor puts it in the term sheet, some reserved matters. If the company will do merger and acquisition, if the company will sell assets, if the company will take employees more than certain amount of salary. So these are examples of reserved matters. If these things happen, then the consent of the investor has to be taken. That's why these are called reserved matters. Info rights is very important. The investor has a right to ask information from you, including regular financials and the business of the company. Then last is founder vesting. It is more used abroad. If the investor is unable to get an exit, if the founder is getting an exit from the company, and because investor had invested in the company because of the founder, so he has a right to take founder shares. That's called founder vesting. So I'll move to the next. There are 3 more questions. How to understand critical elements like liquidation preferences, the options pool, and board seats. Liquidation preference is that suppose an investor takes $500,000 of preference shares and $500,000 of normal plain vanilla equity. Then the investor can put it in the term sheet that the preference share will have a 2x liquidation preference, which means whenever the company is getting next round of investments, then the valuation given to the preference shares for an exit will be twice that given to the plain vanilla shares. So it's like a more return guaranteed to the investor, an icing on the cake. Similarly, exits, the first exit which is there in the term sheet is through an IPO. If IPO doesn't happen, then secondly, the company has to appoint a third party valuer, value the equity, and find a third party investor. If that is not possible, then the company has to buy back the equity from the investor at a certain IRR, internal rate of return. If that is not possible, then the founder has to buy back the equity from the investor, promising him a certain IRR. Then there are some clauses which are there like drag along, tag along, and ROFR. Drag along means the investor has 25% shares, but he is getting a further investor for 51% shares. So the investor has a right to take 26% additional equity from the founder, and with his 25% and founder's 26%, total 51% he can sell it to the new investor. Tag along means if the founder is selling some of his shares to a new investor, then the earlier investor has a right to sell his shares also to that new investor. That is tag along. ROFR means right of first refusal. If the company is raising fresh money from new investors, then the initial investor has a right to buy those shares first. Similarly, investor commitment is obvious. Liquidation, I just told you, $500,000 example. Options pool is ESOPs. I told you about vesting, and around 15 to 25% of the equity of the company is usually the ESOP pool. And usually these ESOPs, they come from the founder's equity and not the investor's equity. And reverse pyramid is the last, which means that if you are more senior in the company, then you get more ESOPs. If you are junior, then your ESOP pool becomes lesser and lesser. This is a reverse pyramid. I'll just move on to the next because I think it's almost 12 now. What are moats in business? Moats is something which is, if it is there in the business, then the customer can't move away. Customer is fixated to the business. So I'll give you an example. A lot of men here will buy a Gillette razor. Now that Gillette razor is 300 rupees or probably more. And the blades are very expensive. But because you have spent 300 rupees on the razor, you will keep on buying blades. And you won't realize that the blades are so costly. So that is a moat which Gillette has in its product. Then there is a moat like if you want to buy or sell something, you will use Amazon. Why? because most of the suppliers and customers are there on Amazon. So it is something you can't do anything about. It has the maximum number of suppliers, and so that has become a moat for Amazon. Similarly, platform network effect. Like you have an iPhone which has an app store. Now that app store has millions of apps. Now, if you switch to anything else, you will not get access to those millions of apps. So that is a moat for the company. A moat is a water around a fort because of which the fresh invaders can't enter the fort. So that becomes a moat. Similarly, somebody uses IBM equipment, then they feel that, oh no, if I switch from IBM, it will be so costly. And IBM is, I can't do without it. So that becomes a fear kind of cost moat. So these are some of the examples. I'm happy to discuss individually anytime anybody wants me to. Okay, Apurva?
Yeah, works.
Okay, last question. What does network effect mean in business? A network effect means that the value or utility a user derives from a good or a service, it depends on number of users of the compatible product. So I use Flipkart because I get 10 varieties of a product on Flipkart. But if I use Shop Clues or there used to be Crafts Villa and so many others, then my choice is limited. So, there is the platform in itself has a network effect. So, Twitter, Facebook, Airbnb, Uber, LinkedIn, they are all places which became viral many years back. And because of that, they have become marketplaces in themselves. So I can't do anything about that. I have to use them. Now, indirect can be like somebody has manufactured a computer. Now, a lot of software companies come and make softwares for that computer. So the sales of the computer goes up. So it's an indirect network effect. Similarly, if somebody has used keyboard since a long time, I remember in school days, it's a QWERTY keyboard, QWERTY. So it became so popular because of the ease of typing that it became the de facto keyboard in all the devices. Now, the example, one more we can take, Google AdSense. You set up your own site. Now, you say that I will get revenues by advertisements. If you start going out to advertisers on your own, you'll take probably 10 to 20 years to get business. But Google AdSense is already a platform which is out there and used by majority of the people. So you simply plug and play. You simply plug Google AdSense and use it. So this is about it. If anybody has any questions, I'll be happy to take. And
Yes.
sorry, it became a bit long.
No issues. These were the questions that I had in mind when I thought of financing a startup. And I think I similarly have a few more questions in the chat section, and I'll just take you through them. Okay, so how is it different from iSafe notes in the form of the convertible notes, or they are similar?
They are similar, but iSafe note is like a very early investment. If somebody is making, then they have actually no idea of the valuation. That, we assume from day one, key valuation exercise, if we do, it has no purpose because right now not much business on ground. So the investor has standardized the iSafe, and it's more like a convertible which will get converted at a discount to the future round of valuation. So it's like saying, I am putting money on this founder. Whenever the next valuation will happen, my money will get converted at a certain discount. Finished. Very simple. This is what Y Combinator does. You go to Y Combinator, they issue you money, they give you money against 1 or 2 pages of signature, and that money is type of a debt also and equity also. If the first valuation, the next round, whatever happens, Y Combinator gets a discount. Else that remains as a debt, and you can return back the money also to Y Combinator.
Okay. Okay.
Just
And
a
next,
follow-up question, like Prashant. Yeah. So,
Yeah,
like
I appreciate
yeah, so when they give you money, so that money will be turned out to be will be taken up as a valuation in the future rounds. Like if they put up some money, like without
Yeah,
valuation, but they will
suppose
be
they have given you 1 crore. Okay, they have given you 1 crore. Now your first round which happened in the future was at 10 crores. So they gave you 1 crore, so they should get 10% equity. But they gave you money early, so they took a lot of risk. So they expect a certain discount on the future valuation. So instead of uh, them getting 10% because of 10 crore valuation, they will get more, probably 20% or 15%, depending on the formula.
got it.
Oh, thank you.
Next question is by Sanjeev, and kind of my favorite one because I do a lot of juggling in REITs and InvITs in terms of theory. So he has asked, can you please shed some light on how difficult it is in India for the real estate company to take a REIT route?
See, India real estate problem is that the land prices are mostly in cash. Because they are in cash and because there are high stamp duties across states and central government, so a lot of transactions happen in cash. Now, I look at the time when DLF was getting listed on the stock market. At that time, it was 2005 or something, and there was a boom in the market, a lot of liquidity, a lot of cash floating around in the market in IPO. So every company was coming out with an IPO. So real estate was only going up. People hadn't seen when it goes bust what happens. People had no memory. So all these real estate companies, they came out with their IPOs, including DLF. Now, how was DLF valued? It was valued at net asset value, which means whatever land it owns, if it gets constructed and sold, what will be the value of that money in today's terms?
Right.
So whatever they hadn't constructed also, they got value for that. So what was the exact question? I was just giving this
So
example.
how difficult it is in India for a real estate company to venture through a REIT route?
No, REIT route is not difficult, but it is used only by the top companies because of many things. How many companies can you count in India who have stable rental and lease cash flows on their own buildings, with which can be converted into a REIT? You will come up with probably 15 names or 20 names. And all those, they do REITs. The others, they don't get a chance because either their cash flow visibility is poor, their lease agreements are not very captive, and so on.
Correct. I think also from my limited knowledge on REITs and InvITs, so REITs really require a stable cash flow, like Tushar sir was mentioning. And just because a common man have or face difficulty in keeping the rent rates constant or increasing at a fixed rate, like say 5% or 6% based on the inflation rates, this is difficult for a common man. So that's why real estate companies venture becomes a difficult task in India. Otherwise, it's easier.
Yeah, right. Correct.
For Tushar sir today. I think it was great. I had a lot of good insights from your presentation.
Thank you. Thank you. I wish everyone all the very best. Thank you for coming. Thank you for listening. Do your best. Stay motivated. That's the biggest part in achieving success. And stay cheerful while doing everything. So, and thank you, Apurva, for a wonderful webinar, and your efforts, they come through, and I only have good wishes for you.
Thank you, sir. Thank you so much.
Thank you.
And guys, feel free to drop a feedback to me or Tushar and reach out to us over LinkedIn. We'll be more than happy to connect with all of you. And if you have a suggestion or a new topic idea, drop an email on in conversation page, a DM or an email over in conversation page. Thank you. Thank you so much.
Thank
Have
you,
a
Purva. I
great
really
weekend.
enjoyed it today. Thank you,
Thank you
everyone
so
else.
much, sir.
Soveet, Ananya, Jim, Tushar, Atul, Arvind, Payal, Ram Krishna. Thank you so much.